Did you know the IRS kills crypto in the new 282-page proposed regulations? I'll explain more. Welcome to the Crypto Bullseye Zone. My name is Kirk David Phillips, and I make common sense of the crypto space. So we knew this was coming because this is a byproduct of the Infrastructure Investment and Jobs Act. And so these regulations are basically clarifying and providing the rule book for how the IRS will implement the taxation of digital assets. So one of the challenges is digital assets being a new technology we all know, and crypto. That definition doesn't show up anywhere in the existing IRS code or existing IRS regulations. Therefore, that means it's hard to apply existing code because it doesn't specifically mention digital asset anywhere. So that's why one of the things that the proposed regulations are doing and the Infrastructure Act has done is provide clarity and provide definitions on digital asset, as well as digital asset broker, as well as specified security, which means brokers would be required to report cost basis as well as proceeds for sales, and so on and so forth. So these definitions basically now bring digital assets into the realm so that we know what they are, in the same way that securities are plastered all over the place in the code, and we know how securities, stocks, bonds, etc. are treated for tax purposes. Now these new definitions allow digital assets to be brought into that same realm. So that's one of the key things that is the starting point to understand. These new definitions now bring digital assets into the fold. So we're going to talk about many different things about how this is problematic. This will be super difficult to cover this because of the length and the breadth and depth of these regulations. So it's going to probably take many videos to cover the issues that are arising from this. So one of the other key definitions is that of what a payment processor is. So it's like we say, what is a broker and who is a broker? And basically this is a very wide net that's cast around the definition of digital asset broker, to the point where you could even say, oh, everybody's a digital asset broker suddenly. And so one of those areas that shows up is with a payment processor. So a payment processor is, in the legacy world, a third party that assists merchants in collecting credit card transactions. And those payment processors are required to file these 1099-Ks, which just simply says that for ABC Company, we collected $108,000 worth of sales for you from credit cards. So now you have digital asset payment processors that do the same thing, except it's obviously for digital assets. So those payment processors are now going to be considered brokers for these reporting purposes. And the information returns are now going to be filed on a 1099-DA. Securities we know, or everybody's probably familiar with the 1099-B, but we're going to have this new version, which is specifically for digital assets, 1099-DA. So what this means is that every merchant has a payment processor. So your Home Depots, your Rite Aids, your Walgreens, your Walmarts, all those merchants, both big and small, have payment processors. So you're going to go through the checkout line, and everybody that uses digital assets. So in a world and a trajectory of where we now replace cash with digital assets, stable coins, etc., and in a world where every person is essentially using that in lieu of cash now, so it's a common thing. Every time you go to the store, use digital assets. That means every time you go through the checkout, there's going to be a new thing on the credit card swiper, if you will, the interface, which is going to force collecting of personal information from all taxpayers, so that these payment processors can then collect and report on this information. So you can see how broad this is, and this is just really outrageous because you can think of just how burdensome it would be for people to go through a checkout line. It's like financial surveillance essentially in its finest, because you're basically tracking every single transaction. And it's no different. It's just, instead of using cash, you happen to be using this other medium of exchange, but because it is what it is, and it's perceived to have a high fraud risk and increase the tax gap, which is what the IRS is focused on, because they think that the amount that should be due to them, there's a big difference between that and what they actually get paid. Now, this is inside and outside of crypto, and I get that. Their job is to close the tax gap. However, that should not be at the cost and the burden of making the taxpayer have to go through extra work, or making other parties have to go through extra work. So basically what this means is that every payment processor, every merchant really, because it's going to feel like it's the merchant, even if it's the payment processor, every merchant is going to now be deemed, even though again it's the payment processor, is now going to be a broker. So that's just going to kind of ruin the experience for and kill the use case for crypto as far as efficient payments and so on and so forth. So that's one of the big things that's problematic that I wanted to focus on in this video. And so let's just to drive that home and what that would look like. And again, we could use this definition or we could use this example in general, but let's say Bob previously had a couple brokerage accounts. Let's say he got 3 1099Bs, which is about what I would say the average taxpayer has, somewhere between 2 to 4 1099Bs. You just don't have that many brokerage accounts. And so, but in the world of 1099 DAs and in the world of crypto, first of all, you could have multiple exchanges. It wouldn't be uncommon for someone to have 4, 5, 6, 8, 10 exchanges, and then you consider the wallets providers and so on and so forth. And we're not even talking about the payment processors yet, but you could, when you add them in there, you could have basically a huge box full of 1099 DAs that a taxpayer could get. So, to manage 3 or 4 1099Bs is one thing, but now let's say Bob, in addition from getting all the 1099 DAs from his Walmarts and the Home Depots of the world, he ends up with, let's say, 23 of these things. Okay, so that means now, including Bob, who's 24, there's now 24 hands in the pie for managing Bob's crypto taxes. Now, you know how the old saying goes, you got a lot of people in the mix, that's going to create problems. I mean, it's just obvious on the sheer number it's going to create problems. So previously, before these regulations, Bob was going to be the only one who was going to be responsible for dealing with his crypto taxes. That's it. Bob was solely responsible. So now you're going to take Bob's sole responsibility away and you're going to hand it to 23 other people. And now in this example, you're going to have 24 people who are going to have their hands in Bob's crypto tax calculation. Now you think that's going to go smooth and seamless? I don't think so. I think it's going to be problematic. So one of my messages here is that this is actually going to create a burden for taxpayers to the tune of being 2, 3, 4 times more work for the taxpayer than it already was. And crypto taxes is already a nightmare. It's already enough for most taxpayers to do to be able to gather this stuff up, even with crypto tax software, and actually get it together in a meaningful way, just because crypto can be very complex depending upon how you use it. So therefore, now you're going to make it even more complicated and have to reconcile, did the exchanges report correctly and so forth. So that's how it's going to double and triple, quadruple the work for a taxpayer. And really, we don't even have the tools available to even reconcile it in this way. So, like I said, it's hard enough for a taxpayer to do it, but now you're going to have them not only do their own work like they still did, but you're going to have all these returns. Then they're going to have to, taxpayers going to go back and have to try to check it and figure out, did every one of these 23 1099 DAs that were reported on me, that's what Bob's going to say to himself, were all those accurate? He's got to go recalculate and figure all that out. So I don't know, maybe it's actually more than 2 or 3 or 4 times the work, depending on the taxpayer. So anyway, that's it for now. To continue to bring you great commentary on this channel and topics in the crypto space, especially around crypto tax, please like and subscribe below. Then please let me know what you think is the most problematic thing, either from what I've talked about or from what you've already heard about these proposed regulations. So please comment below what you think is the most problematic thing.